A key concept of price action that any trader will learn at the beginning of their journey, whether it be from baby pips or other sources, is the concept of market structure. If we're seeing price putting in a series of higher highs and higher lows in succession, we can frame that we're in a bull trend. And if we're seeing a series of lower lows and lower highs in succession, we can say that we're in a bearish trend. Now, the importance of this concept really resonates from a multi-time frame analysis perspective to truly understand if we are in a pullback phase or an impulsive phase when we're framing up trades on the lower time frame. Now let's take a look at an example. What we have here is an uptrend. We're putting in higher highs and higher lows. Now let's imagine that this red arrow is the daily chart, and that's clearly putting in a higher high, a higher low, a higher high, a higher low, a higher high. Now if we're looking at, say, the 1 hour chart, which we'll use as these white structure lines, what we can see is as price is creating this overall daily impulsive leg, we're putting in a series of higher highs and higher lows. Now once the daily chart begins to pull back to form the higher low, what we'll begin to see is market structure changing on the hourly chart. We're going to start seeing a series of lower lows and lower highs. This is important to understand because when we see this on the hourly chart, we can begin to think that price is reversing, that a bear trend is beginning to start, and that price will just continue moving to the downside. Now, if we use the higher time frame sentiment and understanding that price on the daily chart is putting in those higher highs and higher lows, we can begin to understand that when we're seeing this sort of behavior, that when we break structure to the downside on the hourly chart and start putting in lower lows and lower highs, that while we can look for sell opportunities to make trades here, we should be keeping the overall higher time frame picture in mind, and that at some point we are going to put in the higher low if the bull trend is going to continue. So from a management perspective, the trade should be a little bit more aggressive in that regard. And then basically what we will then see is a break of market structure. Then we will start seeing the hourly chart putting in a series of higher highs and higher lows that then will form the daily overall bullish impulsive move that is then creating structure and continuing to trend in a bullish or upwards direction. One of the most interesting things about market structure and trading in general is that there are multiple ways to do the same things, and it ultimately comes down to your own personal preference and what you feel works best for you. Now, when we're looking at market structure, there are essentially 3 different types of ways to map out market structure and identify the breaks of market structure. Now let's go through the 3 different types. The first type we're going to look at is a market structure mapping using the candle bodies and a market structure break identification using the candle bodies. Now if we look at this example, we can see that price has traded up and then traded back down in. We've denoted the high on the close of the bullish candle and the open of the bearish candle as they are identical. We can see that price then moves back in, spikes the highs, trades back down below, and continues downwards. It didn't actually close above this high, so we can say that this high is still the most previous high in this overall move. Now we can see that price then impulsively starts to move to the upside and breaks and closes above this high, and we can denote that as the overall break of structure. Now if we're looking at this from a standpoint of what do these wicks actually represent, it can be seen that this is more of a play on the liquidity of the prior high. We can see that price spiked above this high, so anyone that would have sold here would likely have their stop losses above this candle. It took that liquidity, which then moved price down lower. It took the liquidity of this low and then continued to the upside. And our break of structure would be denoted right here once this candle breaks and closes above this high. Now if we look at the second example, we're going to be identifying and mapping out structure using candle wicks, and we'll be identifying the market structure breaks with candle bodies. So similar to example 1, we can see we have this up move and we have this high candle, which is a swing high because this high is lower than this high and this high is lower than this high. We can see then that price moves to the downside and continues moving to the upside. We spike that high, but we don't actually close above the high, and then we trade back down. So similarly to example number one, we've essentially swept the liquidity of the prior high and then traded back lower, and then price impulsively moves to the upside, breaks, and closes above, which we denote as the true break of structure. Now, if we look at the third and final type of identifying structure, we'll be using the candle wicks, and we'll be identifying the market structure breaks using candle wicks as well. So if we look at this example, we can see, like example number 2 and number 1, price moves to the upside. We use the highest wick as our high, and then price trades down. What we can see then is price then spikes the high, which we would denote as a higher high in this overall structure because this high is higher than this high. And then what we can see is price then begins to trade lower. It breaks the prior low, which then forms a lower low. So our lower high would be this particular area right here. So when price then moves to the upside, impulsively breaking above this high, we would denote that this is the higher high. So when we're comparing this version to the previous two, we can see that this one factors in all of the subtle movements of liquidity that are happening within this overall trading range. Now, I think the biggest thing to stress is that whichever method that you choose is ultimately up to what makes the most sense to you, and I cannot stress how important it is to consistently apply that method across. You can't be using method number 1 one day, then method number 2 another day, then method number 3 another day, and expecting for things to work. But with that said, mapping out market structure and identifying breaks of market structure is really just a framework of how we view trades and how we're setting up to understand an overall sentiment of the market. So for example, if we see prices making higher highs and higher lows, it would make sense to be entering buy positions. And if price is making lower lows and lower highs, we'd be wanting to take sell positions. So we'd be trading in that direction, but we're not actually trading the market structure in its true form. We're going to be focusing more on order blocks, inefficiency, and Wyckoff. So basically, the market structure is just that overall framework to understand where momentum is likely to occur and which direction that we're ultimately trading in so that we can frame our trades in the highest and most probabilistic manner possible. And what we can see amongst all three is they're all very similar in nature. They all come to the same endpoint saying that price is moving upwards, we break structure, and we're creating higher highs. The only clear delineation between the first two is the body versus the wick, but the market structure break is both dependent on a break and close above structure with a body. Now, one key thing to note when we're looking at TradingView data, broker data, is that from one brokerage to another, or one data feed that you're using on TradingView, for instance, Owanda versus FXCM, what you'll notice is wicks will differ. And why does that happen? So each broker uses different data feeds, which has access to slightly different liquidity pools and fills. So essentially, when you are trading with a brokerage, your spreads tend to increase or decrease depending on volatility and market conditions. And you can usually see that on a chart in the form of wicks. But if you're comparing the overall price action between one data provider and another, the one thing that generally speaking remains very true are the candle bodies, which is why method 1 has relevance. You'll see a little bit of a difference when you're mapping out wicks. If you're looking at one broker, this wick may be in the place that it's denoted, but on another broker, it might be actually above here, which is why when you're looking at method number 3, you can get a lot of differences from brokerage to brokerage. And another thing to note on method number 3 is this can be confusing if you're not understanding what's truly happening on the bigger picture, because as you can see, we are in an uptrend till this point, and then we start in a downtrend. And if you're not careful, you might be trying to look for the lower high to essentially catch the lower low. So regardless of which method that you are choosing, you always have to ask yourself what happens after we break structure, regardless of the method that you're using to identify that break of structure. If you see that price breaks structure and then immediately begins to reverse, more than likely that break of structure is not true, or it doesn't have any momentum backing it, so therefore you're going to see some change in characteristic. Whereas if you see a true break of structure that then rallies off or moves down from that break of structure, you can clearly denote that that is a true break of structure and it is following a trend. And also, if you get into these situations where you are confused, where price is making higher highs, lower lows, lower highs, higher lows, and you're not entirely sure what you should be looking at, always take a look at the time frame above. Get acquainted with what higher time frame direction we're actually trading. It is so easy to get lost in smaller time frames and the noise that is on those time frames. For instance, if we are looking at a overall daily uptrend, so we're putting in higher highs and higher lows, and we start to see on the 4-hour and 1-hour that price is making lower lows and lower highs, we might immediately be thinking that we are in a downtrend and that we should only be looking for sells. Well, that may be true on an intraday perspective. One thing we have to keep in mind is, what is the higher time frame suggesting from a structural standpoint? If we know that we are in a heavy bull trend and that price is more than likely going to move to the upside, the lower lows that we're seeing on those lower time frame charts are more than likely a pullback or retracement phase of that daily chart. So when we have that information in mind, we can frame our trades in a completely different manner. And especially when we take that one step further and we're looking at 15-minute, 5-minute, and 1-minute charts, it is so easy to get lost in those market structures when things are constantly switching from bull to bear, bear to bull, and vice versa. That's when it ultimately comes down to looking at the higher time frame charts and remaining grounded on the actual momentum and the overall trade idea that you're trading. Now, I hope this gives you a little bit of insight of the various approaches of mapping market structure as well as identifying breaks of market structure. There is no hard and fast rule of what is better or what is more accurate. As you can see in these examples, they do ultimately come to the same decision, but it's just a matter of how you personally want to view it. So I highly recommend going onto your charts, backtesting this a little bit, figuring out which method makes the most sense for your trading. If you see the first two, we get more liquidity spikes, and you can gain that knowledge and know that on a lower time frame, we're more than likely going to see a series of lower lows and lower highs, creating that retracement leg before we start to see a true change in character to continue that trend. Or if we use number 3, we can see that we're a little bit more in tune with what the market is doing. We're getting that immediate feedback that once we break a high with a wick, that is our new high, we have our new low, and we're able to have that very quick feedback on the market, but keeping in mind that that will also give false signals. Whereas if we're looking at number 1, this may be a little bit slower to react to certain trends, or you might get also false signals. So that is why it is so important to backtest and understand which one truly gives you the edge that you personally need. And again, one last thing to stress, always keep in mind what the higher time frame is doing. Don't get lost in the noise on the lower time frame charts. And the final bit of importance is what happens after we break structure. Do we retrace back in, or do we continue on the trend? These are the characteristics and questions you should be asking yourself and continuously applying to your trading to be able to make the highest quality trade decisions that ultimately go in line with the higher time frame momentum and allow you to stack confluences so that you're framing your trades in the best manner and taking them in the best manner by having that multi-time frame confirmation and confluence.